Hello, good evening. How are you? I hope you're doing well. Okay, so let's start. And we are into the second class today. Okay, so let me just share my screen with you. Here we go. And here we go. So I hope you guys have went through the recordings as well today. And how much cells? Number. And here we are. Now, this scenario relates to 4 requirements. You should assume that today's date is 15th December 2024. Zai has been self-employed since 2006, preparing accounts to 31st December. On 1st December 2024, Z purchased a new freehold warehouse for 164,000 for the use in his business, but this purchase has resulted in Z having cash flow problems. He has various tax payments becoming due over the next 2 months and would like to reduce or postpone these payments as much as possible. Income tax and national insurance contributions. Z's income tax liabilities and class 4 NICs for the tax year 22-23 to 24-25 inclusive are forecast to be 22, 23, 24, and 25. Income tax liabilities over here, and then we have the class 4 NICs over here. Z has not made any claims to reduce his payment on account. Right? So we have 4 requirements, and this is the one data that we have over here. So we are going to jump straight away towards the first requirement. And this is the calculate the amounts by which Z can claim to reduce his self-assessment income tax and NICs due for payment on 31st January 2025 without incurring the interest or the penalties over here. Okay. And then we have the second requirement for the CGT as well, but we'll go to the CGT later. But now we have this information on the basis of which we have to calculate the amounts by which Z can claim to reduce his self-assessment income tax over here, right? Now, this is where, if I talk about this, question over here, the main part is related to as far as the tax planning is concerned, right? How you plan better as far as the tax planning is concerned, where you can use up the options which are available to you without incurring the extra expenses and all, right? So this is where you have to plan where you can save some bucks as far as from the tax is concerned, right? So the point which we have over here is, I'm going to go over here. As far as the amount, right, that we are going to have over here, this is the period of account for 22-23, this is 23-24, and this is 24-25 over here, right? And this is related to from the tax year 22 to 25 over here. Now, overall speaking, what we can do is we can have the current period of account over here. The current period of account that we have currently, we assumed that today's date is 15th December 2024 over here, right? So it's already 15th December. We have been self-employed, and then on 1st December 2024, we have purchased a free warehouse over here. So basically, the first period of account that we have with us is this 27,600 over here, plus we have 4204 over here, right? So we can have the 50% of that because we can make a claim to reduce the payment on the account is concerned over here, right? So this is going to be, if we take up the 50% over here, we get 27,600 plus 4204 into 50%, we get 15,902 over here. And then we have the revised payment on account over here, and this is going to be for 18,000 plus 3724 over here into 50%, and that is going to be 18,000 plus 3724 into 50%. That's going to be 10,862. And this is something which we are going to deduct from here, right? So we can have a reduction over here of 5,040 over here, right? So we can overall reduce our payment on the account for the tax year over here for the current tax year, that is 24-25, by 5,040, because the balancing amount that we have for the 23-24, which is going to be due by 31st January, that is something which we cannot, like, reduce now at the moment, right? Because this is something which we cannot reduce over here at the moment over here. Done? Now, moving ahead from here, we have the second part where we have this capital gain tax over here. Z has a capital gain tax liability. Z has a capital gain tax liability over here. Just 1 second, please. Okay, Z has a capital gain tax liability of 14,600 becoming due for payment on 31st January 2000 and 25 over here. This is in respect of the freehold building which was sold or for 210,000 December 10, 2023, resulting in a chargeable gain of 76,000. The office building had always been used for the business purposes by the Z. Z is a higher taxpayer. No claim has been made for the rollover relief over here, right? So for this one, I mean, if we talk about this capital gain tax, this is something he will have to pay because this is going to be due on the 31st January now. And this was sold in December 2023, right? So you have this chargeable gain over here, which has to be paid uh, you know, uh, for sure over here, right? So now the second point is calculate the amount by which the Z's capital gain tax liability due for payment on 31st January 2025 will be reduced if he makes a claim for a rollover relief based on the warehouse purchased on 1st December 2024 for 164,000. Now, we are going to assume that the tax rate and allowances for the tax year 24-25 apply throughout. Just give me a second. Okay. Okay, so we have this, capital gain tax over here, which is going to be due, right? So let's see about this. We have, this was the part A over here. Now we are going to go into the part B. And if I talk about the part B, my current capital gain tax liability, which is due, that's going to be 14,600 over here, right? Now, I can revise my capital gain tax liability over here, right? And if I see over here, I had a freehold building which was sold for 210,000 on 10th December 2023. And then I have purchased a new warehouse for 164,000. So I can simply have proceeds not reinvested over here, right? So that are going to be, the building was sold for 210,000 minus the proceeds which have been reinvested are 164. So I will have the amount which has not been reinvested over here. So I will have 210 minus 164,000. That's going to be 46. 6,000, right? So I have this annual exempt amount which is available into the tax table as well. And the current finance side, that is the 3,000 over here, irrespective. So the amount becomes 43,000 over here, right? So the capital gain tax, which I will have over here, according to the 20%, is going to be 43,000 into 20%, that's going to be 8,600, right? So my current tax liability is 14,600. However, I can, I will have to pay this amount over here because this is the amount which has not been reinvested now. So that is the amount on which I have to pay the tax. The remaining amount I can make up as a rollover relief over here. So the reduction which I am going to have over here is going to be 6,000 over here, right? So out of this, the capital gain tax, I can save around 6,000 over here by claiming the rollover relief over here. This is for the part B over here. This now the part C, explain whether the Z can reduce the amount of VAT. Okay. Now, as far as the VAT is concerned, this is the information. Z has forecast that he will have to pay the VAT of 20,200 on 7th February 2025 to HMRC in respect of the VAT quarter ending 31st December 2024. On 12th December 2024, Z dispatched goods relating to an exceptionally large credit sale of standard rated goods of 45,600 inclusive of VAT. He has not yet issued a sales invoice for this sale. Okay. Because the customer is unlikely to pay until the 28th February. So Z is considering not issuing a sales invoice until 1st February 2025 over here. Okay. Now, so he's planning that if he defer the issuance of the invoice, he can save the amount of the VAT on that as well. So we have to explain whether the Z can reduce the amount of the VAT payable on the 7th February by not issuing a sales invoice for the credit sales of 45,600 until the 1st February. And if so, by how much amount, he can reduce as far as the tax is concerned. Now, overall speaking, the question has asked for your advice over here, right? The question has asked for your advice. Now, the point is simple. Normally, we charge the tax on the transactions on the basis of the tax points, right? We charge the tax on the basis of the tax points that we have. So now, what is the tax point? Tax point is the date on which the transaction is made involving the VAT in it, right? So when the transaction is made, which involves the tax or the VAT in it, that is what we call as the basic tax point now. And over here, in this case, this is going to be where we gave the goods, we means the Z, gave the goods to the customer. And if we look over here, the goods, they were given on the 12th December, right? So they were given on as far as the 12th December is concerned, right? The goods, they were given on the 12th December. So if the goods were delivered, on the 12th of December, so technically speaking, if you issue the invoice on the 1st February, or if you issue the invoice at the back as well, it's not going to make any difference over here, right? Because technically speaking, if the invoice is not something which has been issued within the 14 days, of the basic tax point over here, right? So therefore Z, he cannot reduce the amount of the VAT payable on the 7th February over here that he has over here, right? Because technically speaking, the tax point is something which is straight away over there according to the 12th December, and the invoice date of 1st February, that is something it's not going to affect this because the invoice is not going to be issued within the 14 days of the tax point over here. And so Z, it cannot reduce the amount of the VAT which is going to be payable to the on the like this 7th February over here, right? So he cannot reduce it up. End of story. Done. And then calculate the amount by which the Z's pay and NICs due on 22nd January 2025 will be reduced if he delays the payment of the employee bonuses until the 10th January and state when the postponed amount will be payable. Okay, now let's just go over here for the pay at the NICs. Z will have to pay the pay and NICs of 5594 electronically on 22nd January 2025 to HMRC in respect of his 2 employees for the tax month running from 6th December to 5th January over here. Okay. This includes the amount for bonuses, which Z was planning to pay to his 2 employees on 1st January, but he could delay the payment until the 10th January. The bonuses are in respect of the year ended 31st December 2024, and they will be treated as being received on whichever is the date of payment. The first employee has a gross annual salary of 20,000 and is to be paid a bonus of 1,500. The second employee has a gross annual salary of 55,000 and the bonus to be paid is of 5,000 over here. Okay. Now, we have to see that, accordingly over here, that if we can postpone, so what amount are going to be there for related to this, right? So for this, just let me open the tax table as well, because I want to paste the rates over here so that I can show you how basically, I take up the amounts and all and everything. Okay. Now, here we go. And I am going to paste it here. Now, I have my first employee. For the first employee, I have a bonus of 1,500 over here, right? And for this 1,500, okay, the payee is, sorry, 1,500 and the advanced taxation is normally at the 20%, right? Because his annual salary is basically this 20,000, so he's into the basic band over here, right? So that's gonna be 300 over here, right? Now, as far as the NIC is concerned, the employee NIC is going to be, for the employee, that's gonna be 8% over here. So that'll be 1,500 into 8%, right? And then for the employer, that's gonna be 1,500 into class 1 employer, 13.8%, right? So 1,500 into 13.8. So we'll have this one over here. Then this is first employee. Second employer, again, pay. The amount of the pay bonus is basically 5,000 over here. So with the 5,000, he has an annual salary of 55,000. So we are into the higher tax bracket over here, and the higher tax bracket they gives you the tax of the 40% over here. So 5,000 into 40% is going to be there. And then for the employee above 50,000, that's going to be 2%. That's 5,000 into 2%, right? And then I have for the employer, that's still over and above 13.8%. So I have this 5,000 into 13.8%. So that's going to be 690, right? So if I postpone it, the total that I get over here is 3417 over here. That the amounts, like, the Z has to pay. So if it's postponed, the saving will be of 3417 for now, which will be payable after 1 month's time on. Okay, the payment was to be due on 22nd January, na? So it will be paid on 22nd February 2025, right? So if it's postponed at the moment, you can save around like 3417 for now. For now, you can save around 3417, but eventually, obviously, uh, after 1 month, you will have to repay, right? So the question was asking like how much you can save for now, maximum, na? So that you just come out of this cash flow difficulty over here, right? So, but just by delaying like around 9 to 10 days, this 3417 can be saved for now. Done? Okay. Now, this is what we have for this question over here. Basically, this is a tricky question over here, typical one, where you will have to have a better sound knowledge related to as far as the planning and everything is concerned. Now, moving ahead from here, we are gonna go into the question 116 now. This is the HANA question over here. There we go. And I go with this one. Okay. Now, this scenario relates to three requirements. HANA has been trading for many years, preparing accounts to 31st March. So on 1st January 2025, she commenced part-time employment with the Lonely Limited as well. Okay, and the following information is available in respect of the tax year 24-25 over here. So, self-employment, HANA's tax-adjusted trading profit for the year ended 31st March 2025 was 81,770. This figure is before taking into account as far as the capital allowances are concerned. HANA likes to use the accrual basis over here. Okay. On 1st April, the tax written down value of the HANA's plant and machinery were as well as main pool is 25 and the car is 7,700. Then the car has a CO2 emission rate of 105 grams per kilometers and is used by HANA 40% for the business mileage. Okay. On 15th May 2024, HANA bought office equipment for 4,500. And then on 17th August 2024, she replaced her old car, which had been purchased for 11,200, by exchanging it for a new one. Okay. With a part exchange allowance of 10,000, HANA had to pay an additional 25,000 for the new car. The CO2 emissions rate of the new car was 45 grams per kilometer, and the private usage remained the same. On 31st December, she sold some of the old plant for 24,500. Okay. Now, this is something which she has related to self-employment, and then the employment thingy starts over here. So technically speaking, we are going to have one requirement for this self-employment. So we are going to straight away go down into the requirements and look over here. calculate the trading income assessment of the Hannah for the tax year 24-25 over here, right? So trading income is where she is into the self-employment thingy. So I'll go over here. This is the part A, and I will have my trading income assessment for the tax year 2024-25 over here. So I have my trading profit for the year. This is somewhere over here. This 81,770, right? And then I will less the capital allowances from here. And obviously for the capital allowances, I have to do my workings. So working one is going to be of capital allowance. So this question is basically dealing with as far as the capital allowance is concerned. Okay, so capital allowances, I will have the balances over here. I mean, the amounts, the narrations. So I had this AIA, I have the main pool, I have the car as well, now. So I will go for the private use of the car. Private use, right? And then I will have my allowances as well. Okay. So tax return down value brought forward. I have main pool 25 and car at 7,700 over here, right? Then I have my additions over here. I did happen to see that there was some new stuff which has been bought over here. So I bought new office equipment for 4,500 over here, right? So I bought, I will write over here, office equipment for 4,500, right? So I will have my AIA on that for 4,500, and I will have this 4,500 over here, right? Okay. Then what is next? She replaced her old car on 17th August 2024. She replaced her old car, which had been purchased for 11,200, by exchanging it for a new one. With a part exchange allowance of 10,000, Hannah had to pay an additional 25,000 for the new car. So she had to pay 25,000 for the new car, and the old car had a replacement value of 10,000. So the new car purchased. Okay, we are going to have the new car over here. New car 2. So that's going to be 20,000 the amount she had to pay and 10,000 the replacement. So that's going to be for 35,000 over here. Right? Okay. The CO2 emission of the new car was 45 grams and the private use remained the same. Okay, so now she has the private uses over here as well. Okay. So the private use, if I look over here, the 40% is for the business use over here, business mileage. So 60% is the private use, and same goes for the, older one as well. Okay. So now the old car has been disposed of. So I have my disposals. So I'm going to list my disposal over here. So old plant has been disposed of for 24,500 as well. And we have disposed of the old car as well. First take up the old car over here. The part exchange allowance is 10,000. So I will go and I will minus the 10,000 from here. Right? Then we have old equipment disposed of for 24,500. So I will minus that as well. Right? So these two are disposals over here. So I will have remaining balance over here, that's going to be 500, and that's going to be a balancing charge over here. So for 2300, we have a balancing charge. So this is going to be the small pool WDA. All 500 will be charged over here, right? And this is the balancing charge for 2300 that we have. And over here, for this balancing charge, 40% is the private and 60% is basically going to be for the, business over here. So this 2300 into 40% is 920. So I will minus the 920 from my allowances over here, right? Okay, and then I have this new car over here. So on the new car, this is going to be the WDA at 18%. So this is going to be 35,000 into 18%. That's going to be 6,300. And from the 6,300, I will have the allowance over here. So that's going to be with the 40%. So that's going to be 2520 over here, right? And then I will have my total written down value carry forward over here. So I will have remaining allowance, remaining amount over here. And then I will have my total allowance that I take into account is 6,600 over here, right? So I will go over here, I will minus my 6,600 over here. So I will get my tax adjusted trading profit for 75,170, and I will call it as a tax adjusted trading profit for the year, right? So this is what I am going to have over here. Done? Okay. Now, moving ahead from here, I hope it's clear. Now we have the self-employment done. Now this is the employment thingy over here. On 1st January 2025, Hana commenced part-time employment with Lumley Limited, earning a gross annual salary of 125,000. Lumley Limited also provides Hana with the following benefits. Number one, living accommodation. On 1st January 2025, Hana moved into a property owned by the Lumley Limited, which does not qualify as a job-related accommodation. The property has an annual value of 16,000. The property was purchased by the Lumley Limited on 1st September 2022 for £250,000, and its market value on 1st January 2025 was 280,000. So this is the living accommodation. Then we have the beneficial loan. Then we have the trading expenses, travel and expenses over here. Okay, so we have these multiple ones over here. So now calculate the employment income of the HANA, and you should indicate by the use of zeros for any items which are not taxable or deductible over here. So after this, I'm gonna go over here into the part B, and that is the employment income for the tax year 24-25 over here. Oops. Here we go. Now, we have, okay, this is way too far. Let's have it over here. So, part-time employment annual salary is 125. So, annual salary, and we got it on 1st January. So this is gonna be January, February, March, 3 months only. So annual salary is 125 into 3 by 12. So that's going to be 31,250. Right? Then we have the living accommodation. I'm going to go with working 2. I'll have my workings here. Working 2 is living accommodation. And that is going to be, I have my annual value of the property. The property has an annual value of 16,000. Right? With the 16,000, I have to check for the additional charges, if any. So the property has an annual value of 16,000. The property was purchased by the Lumley for 50,000, and its market value on 1st January was 280,000. So this is the 1st January 2025, right? So this is just in the, like, the time frame of the 3 years over here almost, right? So I will take up its purchase price over here for the 250,000, right? And the standard amount allowed is the 75,000. So I'll take up the additional charge over here for the property, because this is a expensive accommodation, huh? So additional charge is going to be 250,000 cost minus 75,000 threshold multiplied by 2.25 over here, right? So the additional charge is 250, 123 minus 75, 123 into 0.0225 over here. So that is 3938 over here, right? So I get a total of 19,938. Okay. And this is the total amount. So over here, the taxable benefit for 3 months is 19,938. The annual benefit multiplied by 3 by 12. So we get 19938 into 3 by 12 for 4985 over here. So my living accommodation 4985 is going to be there, right? Then I have my beneficial loan over here. Lumi Limited provided Hana with an interest-free loan of 60,000 1st January. She has repaid 2,500 at the end of each month, starting the 31st January. Okay, so the taxable benefit in respect of this loan is calculated using the average method over here. So I have this beneficial loan over here, right? So overall speaking, as far as this beneficial loan is concerned, all I'm going to do is I'm going to have the balance at the start. Then I will have its average over here, right? And after the average, I will simply multiply it with the average at the standard rate of interest, that is 2.25%, and I'll have it with the 3 by 12 over here, because I have to calculate my average loan over here. So I will call it as the beneficial loan with the working 3. I'll go in the working 3, beneficial loan. And as far as the loan is concerned, I will write balance at start, on the 1st January. So the balance is 60,000. Then balance at 31st March, or let's say 5th April. 5th April, this is gonna be, let's just write up the workings over here. That's gonna be 60,000 minus, I have repaid 2,500 over here, multiply by 3 months. So I will have this 60,000 minus 2,500 into 3. So that's gonna be 52,500. Total loan is going to be this 112,500, right? So average is divided by 2, this by 2. So that's going to be 56,250. So my taxable benefit is 56,250 into 2.25% into 3 by 12 as well. So 56,250 into 2.25 into 3 by 12 is going to be 316 over here. So my beneficial loan, 316. Done. Simple, straight working. Right? Okay. Now, after that, I have my travel and expenses. During the period 1st January to 5th April, Hana used her private car to travel 6,000 business miles. She was reimbursed at the rate of 50 pence per mile over here. So I can call it as a mileage allowance. I'm gonna go in working for mileage allowance. Okay. Allowance allowed. We had 6,000 miles into 45 pence. So this is allowed less reimbursed. 6,000 miles into 50 pence. So 6,000 into 50 pence is 3,000. So balancing charge as benefit is 300. So 300 is to be charged as a taxable benefit over here. So mileage allowance 300, right? Then Han also paid out 450 for room and count for the hotel rooms which she stayed in during the business trips. Lumi Limited reimbursed her for these expenses. So this is the reimbursed expenses. Reimbursed hotel expense for business trips. We are going to have the zero over here, right? Because these are reimbursed and these were totally related to the business. So that's going to have a zero impact over here, right? So our employment income is going to be 36,851 over here, right? Okay. Now moving ahead from here, explain how the tax treatment of the property provided to Hana would differ. It was qualified if it was qualified as a job related accommodation. I mean, if it had have been the job related accommodation, then obviously it would have been exempt from the tax and we would have taken the zero over here. No working would have been required, and simply by writing the living accommodation, we would have written only the zero in front of it because this was something which is related to the job. Done? Okay. So this is what we have. Right. Now, just pause for 2 minutes and we are starting. Just 2 minutes only. Okay, we have this Ashura question now. This scenario relates to four requirements. Ashura has been employed by Rift PLC since 1st January 2021. She has also been self-employed since 1st July 2024, preparing her first accounts for the 9 months period ended 5th April 2025. The following information is available for the tax year 24-25 over here. Okay. So this information is available now. First, we have the employment thing over here. And it says that during the tax year 24-25, Ashura was paid a gross annual salary of 56,200, from which she paid 5% of the RIF PLC's occupational pension scheme. Then on 1st January, Ashura personally paid two subscriptions. The first was a professional subscription for 320 paid to HMRC's approved professional body. The second was a subscription of 680 to a health club, which Ashura regularly uses to meet the RIF PLC's client. And then Ashura was not reimbursed for the cost of either of these subscriptions by the RIF PLC. And then during the tax year, Ashura contributed 3,400 gross into the personal pension scheme over here. Okay. So this is basically, related to as far as the employment is concerned. Now, second one is the self-employment over here. Okay, and then we have the other information, then we have the self-assessment over here, and then calculate the Ashura's tax adjusted trading loss for the 9 months. Okay, we have to go and talk about this self-employment as well. Now, Ashura's tax adjusted trading profit based on draft accounts for the 9 month period ended 5th April is 10,930. However, this figure is before making any adjustments required for the cost of the Ashura's office. Note 2, okay, this one. For the Ashura's office or the capital allowances in the note 3, and she suspects she will actually have an allowable loss for the tax purposes. Okay. So technically she has a 9 month profit, but the following 2 points are not included in this. The first one is Ashura runs her business from a newly built office. The construction began on 2nd November and completed on June 2024, shortly before the Ashura started trading. So no deduction has been made for 110 for the cost of the office in calculating the profit of 10,930. The cost of 110 was made up as follows: building, heating system, water, and decoration. Okay. Then on 10th June, Ashura purchased a laptop for the use in her trade for 2,600. On 1st June 2024, Ashura purchased a car for 19,200. CO2 emission is 87. And then during the 9 month, Ashura drove a total of 8,000 miles, of which 2,400 for self-employed business journeys. Then we have the other information for the total income for the 4 tax years, and then we have the self-assessment over here. So now we have to calculate the adjusted trading loss for the 9 months over here. So I'm gonna go over here. This is the part A, trading loss adjusted for 9 months to 5th April 2025 over here, right? This is basically the question's requirement. So I am going to have my draft profit over here. Okay, I'm going to cut it from here. I'm going to place it right in front of it, and then I can do it up and down. First thing first is draft trading profit. And that is 10,930. Right? After that, I have this second point over here. As far as the building is concerned, on this, I am going to have a capital allowance. Heating system, water system, I am going to, have the allowances on these as well. right? And yeah, so basically, as far as the heating and lighting is concerned, or the heating and the water are concerned, these are the integral features of the part of the cost of the building. So they are going to be qualified for the AIA as well, right? But as far as the decoration is concerned, this is the revenue expenditure. So I will have it separately over there. Done. So now I will go as far as for the decoration of new office is concerned. I will minus this 3100 is concerned. Then I will have the structured building allowance over here. I'm gonna go into the workings, and the working one is going to be the structured building allowance is concerned. Now, this structured building allowance, if I talk about, this structured building allowance is concerned, you remember the allowance which is available to you, that is the 3%. Remember that structured building allowance, right? So that is what we are going to put in and bring in over here. Done? Okay. Okay, I was not over here. Now, we are going to write it as qualifying expenditure, right? That is the building cost over here, which is 97,600, because this heating and water, I will have the AIAs on those, right? Not on this one. So structured building allowance at 3% is going to be available to us. So that's going to be 2928 over here, right? This is for the whole year. And the construction is completed in June, shortly before she started trading. And she started trading from July, because it says the accounts are for the 9 months over here. So I have to time a portion my SBA over here over the 9 months. So that's gonna be 2928 into 9 by yeah, by 9 by 12. So that's gonna be 2196, right? So I will have the structured building allowance with 2196 over here, right? Okay. Then I am going to have my capital allowances over here. Now, as far as the capital allowance are concerned, I will look into this. Okay. So this is going to be the simple one. This is going to be the main pool. This is going to be car. I had a car over here, which, I draw for personal as well. So I have a private use car, then private use car, and then I have the allowances over here as well. So I will have, do I have any balance on the WDA over here? So 9 month period ending. Okay. I don't have any over here. Okay, so I have a car with 19,200. So I'm gonna simply write additions car. The private use car is for 19,200 over here, right? And then I have additions with AIA. I have this heating system for 5,100. I have this water system with 4,200, right? So I am going to less this AIA allowance. So that's going to be this one. So I will have this 9,300 allowance over here, right? Then I have this laptop which I purchased. I purchased a laptop somewhere. I did happen to read this one, 2,600, right? So I will have the AIA on this as well. So this 2,600 over here. Then for the private use car, I have the WDA over here, right? And this WDA is going to be, available. And as far as the Ashura cars basically has an emission of 87 grams over here. This 87 grams, this is above the 50%, right? So if it's above the 50%, so technically speaking, only the allowance which is available over here is going to be 6% over here, right? So WDA at 6% is what I am going to have over here. So 19,200 into 6%, and I have to adjust it as well. And basically I purchased the car on the 1st July. So technically again 9 months. So into 9 by 12, that's 864. And private use is 2,400 for self-employed. Now, so 2,400 by 8,000. So 2,400 by 8,000. This is going to be 30% over here. So 864 into 30% is going to be 259 over here, right? So my total allowance, which I need to have over here, is 12,159. So 12,159 is what we are going to have over here. So tax adjusted trading profit or loss. This is a 12, so it's a loss as well. So I'm gonna have this 6,525 over here, right? Okay. Now, so we have calculated our tax adjusted trading loss over here. Part B is explain why it would not be beneficial for Ashura to claim the loss relief under the provisions giving relief to a loss incurred in the early years of trade. Okay, you should assume that the tax rates and allowances for the tax year 24-25 also applied in all previous years or the tax years as well. Overall speaking, if I talk about the trading loss, overall speaking, uh, the trading loss, which is normally adjusted, if I look at the previous years now, this is used for the income of the earliest year, right? The earliest year. So if I look over here, I just have an income of 10,700 over here. Then I have the 10,400 over here. And then I have this 48,000 and 54,000, right? So in the first 2 years, if I look, technically speaking, as far as for this 12,000 is concerned, this is just 10,700, which is automatically covered by the personal allowance of 12,570. This is already covered by the personal allowance. So if I try to opt for going to claim the loss, incurred in the early years is concerned, if I try to claim against this, my personal allowance will go wasted, right? So the entire loss, right, which I have over here, it's not gonna bring in any benefit whatsoever is concerned, right? So this is the issue over here. Done? So there's no point of claiming the earlier loss is concerned. That's not going to be beneficial over here, because obviously we already have the personal allowance over here. So it's not going to be beneficial over here. Done? Okay. Then the third point is, assuming that a Shura claim loss relief against her total income for the tax year 24-25, calculate her taxable income for this year. Okay, now this is something. Yes, we can. And I'm gonna go for the part C, that is the taxable income for 2024-25 over here. So we have our employment income first. So if I go into my employment income, I had a gross salary of 56,200. Gross salary 56,200. Then I had pension contribution. This one, 3,400 of the pension contribution over here, 3,400. So the one which is gonna be allowed to me up to the point is, okay, this one, 5% of the occupational pension scheme she paid now. So I am going to write my pension contribution. I have the occupational one. Occupational is 56,200 into 5% over here that I have. So 56,200 into 5%. Then I have my personal pension, and there's no personal pension. I have zero over here. Then I had my subscriptions. One is professional to HMRC, that is deductible, that is for the 320. And then one is a health club, which is personal, that's going to be zero over here, right? So the total income is 53,070, right? And as far as the loss relief is concerned, 6525, this is the loss that we have. So less loss relief part A, 6525, right? So my net income is going to be 46,545 less personal allowance 12,570. So my taxable income is going to be 33,975, right? Okay. Okay. So basically, assuming the issuer claims the tax lawful against the total income, this is how it's going to be done. Now, we have part D over here. State the period during which the HMRC will have to notify Shura if they intend to carry out a compliance check. Oh, in respect of a self-assessment tax return for the tax year 24-25 and the likely reason why such a check, would be made over here. Normally the check period which is available or which the normally the tax authority can do is the 12 months. It's a 12 months period, right? So this is the 12 months after they have received that tax return, right? Now, as if we talk about the self-employment over here, our year end is on the 5th April 2025, right? So within the 4 months, and 4 months and 10 days, right? That is going to be the time period till she has to submit her, tax return over here, right? So this is going to be from the 5th April, count the 4 months. May, after April, it's May, April, May, June, July. Yeah. So that's going to be August next year. So if she submits the return, within like around 10 days or so, I can say this is the 15th April. So 14th April and then 14th August, right? So by 14th August 2026, yeah, by the 14th August 2026, the tax authority, they will have to notify, to the Ashura for, any rechecking of their compliance check, whatever they want to have, they can, right? So I can write it down for the part B over here, that the HMRC will have to notify maximum by 15th April, and then 4 months is August. Yeah. By 15th August 2026. So the HMRC will have to notify the Ashura maximum by the 15th August 2026 related to compliance check, right? So they will have to notify, related to the compliance check by maximum by the 14th or the 15th August over here, right? Now, overall speaking, and the likely reason for such a checkout would be made. Now, what is the likely reason? Likely reason for the HMRC to check the compliance is because it's kind of selected on a random basis or something, right? We can have it on a random basis because we can't say that they have a doubt about it or something, because when they are going to check and then they are going to know that they have a doubt about it or something. So if they haven't checked it yet, we can't say that they have a doubt about the return which has been filed by her now. So the only thing that we can say or conclude is that the choosing for by the HMRC for the compliance check is basically on a random basis, right? So that's going to be on a random basis over here. Done? Okay. So the compliance check by the HMRC of Ashura will be on random basis. That's it. More than enough, right? Okay. Okay. So this is what we have now over here for this. I hope it's clear. Okay. Now let's just have a break of 4, 5, 7 minutes or so. We're going to come back and then we are going to resume with the next question. Let's have a break. Okay, let's assume I have this Mantha fabric question over here. The scenario relates to requirements, and Samantha Fabric has been a self-employed manufacturer of the clothing since 2012. She has the following income and chargeable gains for the tax year 23, 24 to 25, 26 over here. Trading profit or loss for the 3 years. Society and trust chargeable gains, and the chargeable gains do not qualify for the business asset disposal and are not in relation to the residential property. Now, state the factors which will influence an individual's choice of loss relief claims. So if I go for the part A, part A should be over here. It's asking for the factors influencing the individual's choice of loss relief claims. Uh, Overall speaking, the factors influencing the choice of relief, right? These are the ones which you are going to talk about over here, the choice that we have, not the options, but the choices, right? Like, for example, we can say the rate of income tax or the capital gain tax at which the relief will be obtained, right? So the rate of income tax or the capital gain tax on which the relief will be obtained is something that we have to see over here. And the preference is normally given to income tax charged at the higher rate of 40% or additional rate of 45%, because over there, that is the point where you can have, as far as the more relief is concerned, right? Then again, the second point which we can say is the timing of the relief obtained, right? This is really very crucial over here, because if we talk about as far as the timing is concerned, the timing on which you are getting the relief with the claim against the total income or the chargeable, right, of the current tax or the preceding year that we have in the earlier claim, in the earlier relief, than a claim against the future trading profit is concerned as well. Because the timing of the relief obtained, if we are able to get the claim earlier than the later tax year, it is something which is like, preferred as well. Then we can say the amount of or the extent to which the personal allowance, right, the capital gains annual exempt amount, and the saving and the dividend nil rate bands, which will go wasted as well. So these are the factors which can influence as far as the choice of the relief claim is concerned, because obviously the time period where you have a more loss or a higher loss, you will tend to avoid it, right? You will tend to avoid it, because if you have a higher amount of the loss, right? So that is something which you don't want to have at the end of the day now. So that is something which you will try to avoid, right? So these are the factors which can, overall speaking, influence as far as the individual's choice is concerned. Okay. Now, point number B. Calculate Samantha's taxable income and taxable gains for each of the tax year 23 to 25, 26 inclusive on the assumption that she relieves the trading loss of 81,900, this one, right, for the tax year on the most favorable basis, right? Explain your reasoning behind relieving the loss on the most favorable basis. You should assume that the tax allowances for the tax year 24-25 apply throughout. Okay. So basically, we have to have a sound logical base where we can have a maximum benefit, right? So let's start this one. Part B over here. Now we have 23, 24, 24, 25, and 25, 26. 26 as well. Now we have a trading income 21,600. We have a negative amount over here. So we have a zero over here because we don't have a trading profit over here. Then this is 11,650 over here. After the trading income, we have the building society interest. This is 52,100. This is 3,800, and this is 1,850 over here. So we are going to have their total. So that's going to be 73,700 and all, right? So now we are going to less the loss relief over here, right? Now, as far as the loss relief is concerned, we have a total amount of 81,900 over here, right? So we have a trading income of 21,600. This is a trading loss. So we can straight away adjust the loss against trading income. This is 21,600. I will straight away do that because my total loss is 81,900, right? Trading is 21,600. So the balance which I have is 60,300. This is the balance that I have over here. So technically speaking, against other income, I can say as well, this is total 52,100 now. So it is sound to have 50,000 over here, right? So I will have this 50,000 over here. And if I see the balance against the previous year, if I do this, I get this at 2,100. I get this 3,800. I get this at 13,500. As far as less the personal allowance is concerned, that's going to be 2,100 restricted, 3,800 restricted, and then 12,570 over here. So my taxable income is going to be only over here, which is going to be just 930,000 over here, right? Okay. So this is one part where I can have my, as far as the taxable income is concerned, right? Okay. So this is the taxable income thingy that I have over here. Now, I can have this on the basis of the gains over here as well, right? This was on the basis of the income. Now I have these chargeable gains over here. So I can do my calculation on the basis of the taxable gains as well. I have this 2023 and 24, 2024 and 25, and 2025 and 26 over here as well. Right? Okay. Now, my chargeable gains. I have 53,600. I have 0 over here because this is a loss and this is 12,500. Right? Then I am simply going to get less my trading loss relief. And if I look over here, my trading loss relief. Okay, so chargeable gains do not qualify for the business asset disposal relief and are not in relation to the residential property. So if I see over here, I have this amount of this is just gonna be the simple one over here. You know, this is going to be only the 10,300 over here. Yeah, right. So 10,300 is gonna be the one which I can adjust over here, right? Because the later ones I will have a simple balancing amount of 43,300 over here, and the rest of the amounts over here, right? Because if I look, I have because I'm just left with the 10,300 because the balance is 60,300. I have charged this 50,000 over here. So balancing amount of 10,300 is charged over here, right? So I will have my 43,300 over here. This is 0 and this is 12,500. Well, exempt amount, that's 3,000 over here. This is wasted over here because I don't have anything else. And then this is 3,000 over here as well, right? And then my balance over here is going to be 40,300. And then over here, I will have my 9,500 over here. Then do I have any capital loss? Capital loss. Yes, I have this chargeable gain loss as well of 9,700 now. So I will less capital loss brought forward, nothing from here, but 9,500 from here because this is a total of 9,700, na? This one. So I can just adjust it into the next year, right? So that is the 9,500 because the balance is only 9,500 over here. So my taxable gains are, that's gonna be 40,300, 0 and 0 over here, right? So this is what I can have over here related to this one. Done? Okay. Okay, so this is the taxable gain and all that I have over here. And then it says, explain your reasoning behind relieving the loss on the most favorable basis as well. Now I have to go into the reasoning as well. As far as the reasoning is concerned, you know, normally you will have to talk about the approach that you bring in over here, right? Because you just have to talk about the basics why you just went with the the working that you did basically, right? So I can simply say I have two losses over here. Now one is related to the trading and one is basically related to as far as the capital gain tax loss is concerned now. So I can talk about this one over here, because if I look my total loss, this is the trading loss of 81,900 over here, right? So I have to talk about this one over here, that how I put it up over here, because this is the trading loss. In the trading I had this 21,600 in the previous year, then I had this balance over here, and this balance was charged against the other income, and then after the 50,000 that I had, the remaining amount which remained was 10,300, which has been charged over here. So when it come towards as far as the explanation is concerned, uh, the trading loss utilization is concerned, I can simply say that the loss has been claimed as follows. Number one, against the total income for the tax year of 2023-24, right? So this has been adjusted against the total income for 2023 and 24. I had a total income of 73,300. Sorry, 73,700. So against that trading income, I had it for 21,600 whole. And then against the other income as well, I charged it over here. And then the balancing amount is 10,300. So I had the charge or claim against the chargeable gains of the tax year of 2023/24, right? So this gave an auto relief at the earliest date and at the highest rates of tax over here, right? So we had an auto relief over here. Done. Then this is for the trading loss. As far as for the capital loss is concerned, for the capital loss, I had to go into the next year over here. The capital loss for the tax year is carried forward, right? The capital loss for the tax year 24-25 is carried forward and set against the chargeable gains for the following year. The use of BROUGHT, brought forward capital loss was after allowing for the annual exempt amount of the following year, right? Which avoided the wasting of annual exempt allowance or amount, right? So we have this 9,500 here, and then the remaining amount. We had this 9,700. So remaining amount of 9,700 minus 9,500 is 200, is carry forward against the future gains over here, right? Okay, so this is what we have as far as for the future gains is concerned. Done? Okay. Now, moving ahead from here, so we just had this whole discussion over here. let's see. We have now next question related to Michael and Scene over here. This scenario relates to three requirements. The UK government uses the tax policies to encourage certain type of activity. Briefly explain how the UK government tax policies encourages the individuals to save, individual to support the charities, and the entrepreneurs to build their own businesses and to invest in plant and machinery. Okay. So technically speaking, this is a relatively straightforward theoretical question, right? And talking about the individuals, you know, simple thing that you have to keep in your mind is you are going to discuss about the policies, you know, which encourage the individuals, as in a sense, the individuals are only going to be encouraged when there is some sort of a tax saving, right? If by a way we can save our tax, that thing or that event is something which is going to be encouraging for us, right? Because apart from that, anything that if we have to pay a certain amount of tax or something, then that is something which is not going to be encouraging, right? So, overall speaking, if I talk about from the individual point of view, if I talk about from the individual's point of view, I can simply say if you being the individual is over there in the UK, we would like to invest in the savings account, the individual saving accounts, because they are tax free, right? We would like to have the relief on the amount of the pension contributions that we do, because the more contribution we do, the more relief that we get. Then we have the savings in the nil rate band as well, which basically encourages the basic taxpayers or the higher taxpayers to save by providing the tax-free saving income as well, right? Then the second point that we have is to individuals to support the charities over here. Now, for the charities, we have seen that when we do a certain charity, we are, straight away given a relief on the spot of the 20%. That is, in actual, we are paying a 20% less amount, right? But when it comes towards the tax return, we minus the higher amount. And then again, our tax bracket is increased by the gross amount as well. So I can simply say that the charitable support is encouraged by giving the individuals the tax relief on the donations or on the payroll deduction schemes as well. So basically, we get that 20% relief now for the basic bonds and then for the gross amounts that we do. So that is something we can straight away write up over here as well. And then talking about as far as these entrepreneurs are concerned to build their own businesses and to invest into the plant and machinery is concerned, we have seen in the self-employment cases that we have the capital allowances and all, right? So we simply have the capital allowances over there if we buy our own non-current assets over there, because the investment in the plant and machinery is going to be straight away attracting the capital allowances. And we are going to have a heavy deduction related to the capital allowances from the profits. Then, technically speaking, if we have our own businesses, we can have the reliefs via the capital gain tax. We can have the relief via the business asset disposal relief as well, right? So these are the reliefs which are available from the entrepreneur's point of view is concerned, right? So these are the multiple which you can write over here in simple 2 to 3 lines to explain your point. You can write them over there, right? Okay, then moving ahead from here, if we talk about the part B, this scenario relates to one requirement, and you are a trainee chartered certified accountant, and your manager has asked for your help regarding the two taxpayers who have both made the trading losses. Okay. Michael started in self-employment on 1st July 2023, preparing accounts to 5th April. His results for the first two periods of trading were as follows. For the 9-month period ending 5th April, it had a trading loss of 24,600. Then for the year ended 5th April 2025, it had a trading profit of 7,100. For the tax year 2019 to 20, and then from 21 to 22, Michael had the following employment income as well. Okay. So for the 9 months, it had a loss of 24,600. And then in the year ended, he had a profit. However, for the previous years, he had these profits over here. Michael did not have any income during the period from 6th April 2022 to 30th June 2023. Okay. So at that time, he didn't have any income. And these were the employment income. So he took a break of these couple of months over here. So the requirement is for each of the two taxpayers, Michael and Sean, identify the loss relief claims that are available to them and explain which of the available claims would be the most beneficial over here. Okay, so we have our trading loss of 24,600, right? So this is a loss in the first 9 months of the opening year, right? So for Michael, we can have a special opening year loss relief over here, right? And the loss relief arising in the tax year 23-24 can be claimed against the income for the 3 preceding years, preceding tax years, right? Earliest first, since it is incurred in the first 4 years of trading, right? So this is a special opening year loss relief. Then, as far as the amount of loss claim is concerned, the loss claim will therefore be, I have this 24,600, so I can straight away have this in 2021 over here of 17,200, right? And then the remaining is going to be in 21-22 over here from this one. So I can claim 17,200 in 2020 and 21, and remaining amount of 24,600 minus 17,200, 7,400, right? So remaining 7,400 in the tax year 2021 and 22 over here, right? Okay. So this is the amount that we can claim over here, amount of the loss claim. Then we have tax saving over here. Now, for the tax year, if I look over here, 21, this one, 2021, this 17,200, right? This is going to waste 2021 will waste the personal allowance, right? This will waste the personal allowance over here because we have this 24,600 and this is the 17,200 over here now. So this is going to waste the allowance over here, right? And for the tax year 2021-22, Michael has income of, this is 51,000 now. 51,000 minus 7,400. So that is 43,600, right? So he's an income of 43,600, right? So with this, overall 43,600. This is 51,000, right? So this is going to be taxed at the higher rate over here, right? It will be subject to income tax of 40%, right? So the claim of 7,400 will save the tax at higher rate, right? So the tax is going to be saved on the higher rate. And now this is going to be remaining is 43,600 now. So the basic rate is the basic band is up to 37,700. So 43,600 minus 37,700. So we are left with the 5,900 over here, 37,700 over here. Yes. So we can have, yes, this amount. So the tax is going to be saved over here. So the 43,600, it will be subject to the income rate of the 40% over here. So the claim of 7,400 will save the tax at the higher rate, right? And we can simply say that this 7,400 is a claim now. So 7,400 minus the 730, we will have a saving of 6,670 will be saved or will be taxed at 20% over here, right? Because this is the amount which we are going to save. So 6,670 is going to be taxed at 20% rather than going for the 40%. So this is what we can save over here, right? Second point. Okay. Now you should assume that the tax rate and allowances are for the 24-25 over here. Now the second point for the carry forward of losses is concerned. Now, Michael can carry forward the losses or the trading losses against the future trading profits as well, right? But overall speaking, the future profits are just 7,100 now. But the immediate future profits available are just 7,100, right? Which is less than the personal allowance amount as well, right? So no tax can be saved in this year, right? As far as the future years are concerned, we don't have any information about what profits will be there. So, most beneficial for Michael is to claim the opening year loss relief. So best way for the Michael is to claim for the opening year loss relief. Okay. Then we have the Sean over here. For the Sean has been self-employed since 2013, but ceased trading on 31st March 2025. Okay. So he has always prepared the accounts to 31st March. His results for the final 5 years of the trading were as follows. So we had number of trading profits in the previous 4 years, and then in the latest year we had a trading loss of 26,700 over here. For each of the tax year 21, 24, 25 inclusive, on has a property business profits of 12,570 as well, right? So the requirement is for each of the two taxpayers, we have to identify the loss relief claims which are beneficial over here. So for the Sean, the amount of the loss for the tax year, this is going to be 24, 25. 25 is 26,700, right? Now, loss relief available. First is the terminal loss relief in the last year of the trading, right? So the whole of the loss can be claimed as a terminal loss since it is for the final 12 months of trading, right? So we can claim it up. The claim is against the trading income, right? For the tax year of the loss and the 3 preceding years as well. So the amount of loss claim, the terminal loss claim will be therefore that we have. Okay, so this is terminal loss. Now if we go back, we can have 3,700 in this year, 18,900 in 2023, and then the balancing is gonna go back over here. So the terminal loss will be therefore 3,700 in the tax year 2023-24. Then we have 18,900 in the tax year 2022-23, right? And 26,700 is the total. Minus 3,700 and then 18,900. So the balance is 4,100 now. So 4,100 in the tax year 2021-22 over here, right? So these are the loss claims that we can have over here, right? Now, as far as the tax saving is concerned, the property business profits are sufficient to utilize the personal allowance for each year, so the loss relief claims will have save income tax at the basic rate of 20%, because we have this whole saving over here, so we can straight away have this loss relief over here, right? Okay, now moving ahead from here, if we talk about as far as the standard loss relief is concerned, just give me 1 second, please. Okay, now we were into the standard loss relief. In the standard loss relief, what we can do is that Sean can also claim the loss relief against against the total income for the tax year 2024-25 and for 2023 and 24 as well. But this would waste his personal allowance for either or both years. So the most beneficial claim the terminal loss relief. Right? Okay, now let's just pause for 2 minutes and then we are resuming again. So let's start again. This scenario relates to four requirements. Amanda's taxable income for the tax year 24-25 is we have the employment income, property income, total income. Then we have the deductions. Then we have the net income and the personal allowance, and then the taxable income as well. We have living accommodation partnership, and then we have lots of information over here. And now the question says calculate Amanda's taxable benefit for the tax year 24-25 in respect of the living accommodation provided by her employer over here. So we have to calculate the living accommodation benefit over here. So I'm going to go in part A. This is Amanda's taxable benefit for living accommodation over here. Now we have annual value over here. This is a living accommodation, right? So I'm gonna trim it down till this point. So for the period from 1st November to 5th April, Amanda's employer provided her with a living accommodation. Her employer had purchased the property on 10th February for 174,000, and it was valued at 194,000 on 6th April 2024 and at 194,000 on 1st November 2024. Improvements costing 8,000 were made to the property during the year, and the annual value of the property is 6,300. So the annual value of the property is 6,300 over here. So we can have the additional benefits over here. Cost to 10th February 2022, right? That is 174,000, right? Then we have, it was valued at 192,000, and improvements were costing 8,000 were made to the property during May. So we have the improvements of 8,000. So the total is 182,000 over here, right? Now the limit is 75,000, right? So the expensive accommodation is going to be for 107,000. Now, as far as the additional benefits are concerned, these are going to be 107,000 into 2.25%. So that's going to be 107,000 into 225 is 2408. Then with this, the property was furnished by the employer during the year at a cost of 12,400. So we are now going to have the furniture for 12,400, and that is at the 20% as well. So that's going to be 2480 over here. So the total benefit is going to be 11188 over here. Now we are going to time apportion it, and that's going to be 11,188 into, I got the property on 1st November. Yeah, she got property in 1st November. So November, December, January, February, March, 5 months. So that's going to be 5 months over here into 5 by 12 is going to be 4662 over here, right? So technically speaking, if you look over here, the property was purchased 6 years before the first time being provided to the Mandana. So that's why the additional benefit I've taken up over here to the cost of the property plus the cost of the subsequent improvement as well. Okay, now the second part which we have is to calculate the Amanda's partnership loss relief claim for the tax year 24-25 over here. So Amanda's partnership share loss relief now. So that's going to be Amanda's partnership share of loss. So if I go into the partnership loss, Amanda has been in a partnership with Banny and Cotton since 1st April 2010 for the year ended 31st March 2025. The partnership made a tax adjusted trading loss of 10,800 over here. Until 31st May 2024, profit and losses were shared equally. Since 1st June, the profits and losses have been shared 15% to Amanda, 60 to Banny, and 25 to Cotton. So basically, we have a time apportionment over here from 1st April till 31st May, right? So April and May, they are going to be 2 months over here, right? So they are going to be 2 months over here. So I will have for the first 2 months till 31st May. So the loss is basically 10,800 into 2 by 12 into. So they were shared equally now. So that's going to be 3 partners over here. So 1 by 3 over here. And this is the loss, not the profit. So that's going to be 10,800 into 2 by 12 into 1 by 3. I get 600 over here, right? And then I have, after this 2 months, I have from 1st June till here, and I have this 10,800 into 10 by 12 into, I get my 15% share. So this is 10,800 into 10 by 12 into 15%. I get 1350 over here, right? So my total becomes 1950 over here, right? Then I have my part C over here. Calculate the income tax and child benefit income tax charge payable by or repayable to Amanda for the tax year 24-25 over here. So I have to calculate the income tax and child benefit over here. Okay. Income tax and child benefit. So I'm gonna go into the part C. This is Amanda income tax okay, repayable. This is repayable. Okay, so we have our taxable income. Now if I go here, this is Amanda's husband. This says the child benefit received over here. And where is the Amanda's taxable income? 54,430, right? In this, I am going to calculate the tax payable, and this is going to be 37,700 into 20%. That's going to be 7540. Then we are going to have the income tax saving over here for this. During the year, the gifted donation was 640 net over here, and each of the 12 months, Amanda employee deducted 1,200 of the Amanda tax over here, and then Amanda has received this 3094 over here, right? So this is the charitable donation over here. So for the charitable donation part, this is 640 now. This is the net amount over here. So 640 by 80 into 100, I get 800 over here. So 800 into 20% as well. That's going to be 160. So this is going to be over there as well. And then I have the balance, which is going to be 54 for 30 minus 37, 700 minus 800. So, okay, I made a mistake over here. So this is going to be 5930 over here. And this is going to be taxed at 40% over here, 6372, right? So my total income tax liability is going to be at 14,072 over here. Now, tax deducted at source under the pay system. Every month, 1,200 has been deducted. So that is 1,200 into 12. So that's going to be 14,400 over here, right? So my income tax repayable is going to be over here. That is 320. So the claim should be there. I have my child benefit over here as well for the Amanda, because I have to get into the child benefit, right? So property income is going to be there as well. Okay. So my child benefit received. The child benefit received is 3094. So I have my net income 67,000, right? Less gift aid donation. The gross amount was 800. So adjusted net income is 66,200 less lower limit of 60,000. So I get 6,200 over here, right? So I get this 6,200 over here. So basically I have 1% per 200 pounds, right? Of 6,200 is 6,200 by 200 is 31. So I get this 31% over here. So child benefit tax charge is 3094 into 31%. 959 is what we are going to have over here, right? Okay. Now we have to calculate the overall income tax saving, right? So this was part C. Now overall saving is what we have to do and calculate over here as well. Now we have Amanda's tax saving over here. We have income tax saving. Income tax saving because 2000 of the property income had been received by the Amanda's husband rather than the Amanda. So this is going to be 2000 into 40% tax save. That's going to be 800. Reduction in child benefit. So that is 3094 into 10%, right? So that'll be uh 2000 by 200 basically, right? So we are going to get 3094 is 309 over here, straight 10% now, so 309, right? And then we are going to have the husband's tax cost over here on the 2000 basically, that is the 20%. So 2000 into 20% is going to be 400. So overall saving is going to be 709 pounds over here. So overall saving 709 pounds is what we are going to have over here, right? Okay, so this is what overall we have over here. I hope it's clear. I mean, if you have any question or something, you can ask me. Otherwise, we are good to go. Okay, so I'm gonna stop over here for the day. Just go through these questions, what we have, learned over here. And if you come across any problem or something, do let me know. I'll be more than happy to assist you and guide you in all this, right? So I'm gonna see you now in the next class. Do go through the videos again. If you come any problem or something, do let me know. Okay, so you're asking, can you please upload the Word document from lecture 16 and 17? Okay, let me check. I guess they are, but if they haven't, I will definitely upload them. I will definitely upload them. Don't worry. Right? Okay. So time to say bye. Take care of yourself, your family, your friends, and the people around you. I'm gonna see you in the next class. Till then, take care. Bye-bye.